Hello and welcome to this Friday's morning market briefing. We've got a lot to talk about, but firstly, US stocks rally as strong retail sales raises hopes of a soft landing, as well as that Citadel and DE Shaw slashed Nvidia holdings ahead of their market rout. We've got lots to talk about on the charts, also with lots happening on the economic calendar, but we'll come to that near the end, so make sure you stay around so you can see that. Before we get straight into it though, make sure you subscribe. The first article we'll talk about is to do with US stocks and the soft landing for the US economy. Now, the US retail sales data was released yesterday, presented a very strong picture for the US economy, with markets being boosted by the strong data. This is due to traders now becoming more confident that the US economy will in fact avoid a recession and thus have a soft landing. Now, of course, this has been a key topic that we've discussed on this channel recently, and of course, it's kind of one of those topics that we always return to because it's so important to understand for us traders, that are trying to analyze stocks and understand what's going on in the market. Now, recently, within the past month or so, traders have become increasingly worried about the prospect of a US recession. Why is this? Well, we started to receive certain employment data and other pieces of economic data from the US, which showed that basically the US economy was struggling more than previously expected. Now, why this is kind of so relevant and so interesting is because the US economy has actually been a large outlier for the past year or even 2 years for the entirety of this kind of post-COVID period, in which we've seen high inflation and low growth in many economies around the world. Whilst in the US we have seen that high inflation, like we've seen in the Eurozone with Britain and others, ultimately what we haven't seen is slow growth. We've seen a US economy which has remained very resilient, very strong, and has really pushed through all the kind of recession fears that many had for the US economy going back to a year or two ago. Now, why that's now changing is, of course, because what I said is that recent employment data, the recent NFP figure, which came out and presented what looked like more of a hard landing, which looked like somewhat of a recession was coming, and this was very worrying for traders, as the U.S. economy, or the Fed, has still not kind of got rid of inflation in the same way that maybe the ECB and Bank of England have. If we look at the Eurozone or we look at Britain itself, we can start to see that inflation is near or at the 2% target, which of course these key Western central banks set as their inflation target. In the US though, previous to the most recent inflation rate figure, inflation was above 3% or at 3%, and it remained that way for the past 6 months or so. Going back to around February or March, inflation hasn't really changed much. It's just been 3% year on year for the past few months, and that's presenting a very big issue for the US economy, as that's with inflation, that's with interest rates at their kind of multi-year high, multi-decade high levels, or around 5.25 to 5.5%. So this is very worrying for the Fed and very worrying for traders as well, who then started to price in this reality. Ultimately though, this recent retail sales data that we've received now presents a different picture entirely. It creates the picture of a soft landing, with this retail sales data showing in fact that there is kind of still interest within the kind of consumer market, and that there is still hope for the US economy despite the kind of worrying employment data that we received recently. The question will be though whether data after this continues to reiterate this message, as ultimately that's kind of what drives the market, as we're seeing here, and one piece of data or two pieces of data doesn't completely change the market trend. It's got to be a repeated piece or a repeated string of data which kind of reiterates the same kind of same message about the markets and about the economy. So we will have to stay up to date with the stuff that's coming out, as we always do. So definitely keep your eyes on the economic calendar next week, and make sure you're checking all the data that's come out for today, as that's really what's going to be kind of deciding whether traders think that the US economy is heading for a soft landing or not. But at the moment, we are seeing this kind of bullish momentum re-enter the market after that kind of recent downturn that we kind of saw play out as a result of those kind of recession fears, and also the kind of other issues which came up, just, very temporary issues, but ultimately have created this large market rout because it's a multitude of factors that have come in at once and have pushed market stocks to the downside. So definitely stay up to date with all that economic data that might be coming out over the coming days and coming weeks, with the S&P 500 as a result closing a full 1.6% higher on the day, and that was yesterday's figures. Now this was enough to wipe out all the losses the index experienced during August. In comparison, the Nasdaq moved a large 2% to the upside. The actual data from the Census Bureau, showed that retail sales had leapt a full 1% in July, which is the most in almost a year and a half, with this figure also coming in far above economists' expectation of a 0.3% increase. The data release helped push the price of Walmart 6.6% higher on the day, as they reported a 4.2% year-on-year increase in same-store sales. This data release is ultimately a massive relief to investors who are beginning to worry that the US jobs market and poor economic reports were a sign that the US economy was heading for a recession, with last month's jobs report printing the fourth consecutive rise in unemployment rate, with that figure reaching 4.3%. This triggered extra fears that the Fed had waited too long to cut interest rates. So, of course, we'll keep you updated on this topic, and it's an interesting one playing out. We're coming to the charts, after the next article, so that's when we can kind of, look back on what we've kind of read and understand what's possibly going on to end off the week, and then what could be setting up for next week as well. But the next article is on the same sort of topic, but more so focusing on the stock of Nvidia, and hedge funds and that kind of thing, who are of course pushing the market one way or another. Now, the top hedge funds of Citadel and DE Shaw have now been shown to have slashed their positions in Nvidia in the lead up to the recent stock market sell-off. This comes as other hedge funds like Renaissance and Marshall Wave, I've spelt Marshall Wace wrong, pardon me, and Marshall Wace have added to their holdings of Nvidia. Now, of course, Nvidia is a massive topic at the moment, as of course it's kind of leading this AI revolution, as we always talk about. Nvidia is almost the kind of foundations, the building of AI, and allows for all these new kind of machine learning technologies and chatbots and AI models to be produced and run, and ultimately therefore Nvidia is very important to that process, and as a result Nvidia has benefited massively off this AI revolution and is soared to the upside over recent years, over the past 2 years specifically, and within the last year we've kind of seen the most movement to the upside, with Nvidia even reaching the kind of title of being the most the most highly valued publicly traded company in the entire world. So that company with the highest market cap that was traded across the world. So that was of course a massive achievement for Nvidia, but since then, of course, we have seen a kind of significant sell-off to the downside. This came for a multitude of factors, but ultimately, what we kind of spoke about in the last article added to that, with fears of a US recession, fears of just a US slowdown, fears of persistent inflation, fears of course, political instability, and also just kind of fears that AI was somewhat being overhyped. The idea that Nvidia had just rose to the most valuable, company in the world, basically, in just, a year or two, is quite absurd when you kind of then compare the fact that Nvidia was had a larger market cap than the likes of Apple, or even Microsoft, and, that kind of led many investors to start worrying and doubting maybe their positions in Nvidia, and therefore we kind of saw that massive sell-off, in which, Nvidia shed around around $400 billion in value in a space of minutes. So that's the kind of situation that Nvidia has faced recently. And what's kind of interesting with this article is it kind of links in the topic of hedge funds with the topic of Nvidia, as of course, you know, is Citadel, DE Shaw, Marshall Wace, and Renaissance and others are ultimately, you know, the kind of market leaders, as you know, hedge funds have the largest positions in these, or asset managers in general have the largest positions within these stocks, and therefore are ultimately driving the markets. You know, it's not the kind of individual trader, it's not the individual retail trader at home that's maybe buying a stock of a share of Nvidia that's going to push Nvidia to the heights that maybe Citadel on their own would. And so it's very important to kind of look at what institutional investors are, look at what these massive firms are doing with regards to these topics, these with regards to these popular stocks, so that we can better understand where the markets might be going and better understand their strategies as well. And what's interesting here is we're kind of seeing this split, we're seeing this divide between minds within the hedge fund space, especially between those like Citadel and DE Shaw, and then those like Renaissance and Marshall Wace, who in fact have added to their positions in Nvidia, whilst those like Citadel and DE Shaw have of course sold large positions in Nvidia. But we will keep you updated on this topic, of course, and we'll be coming to the charts in just a session, in just a second, where we'll look at like the S&P 500, for example, which of course includes the likes of many tech stocks and AI stocks like Nvidia, with Citadel having ditched around about 500,000 shares in Q2 as a result of went from holding $60 million of the stock to just $19 million of the stock. So a massive, kind of sell off there for Citadel, pardon me. In a similar fashion, DE Shaw more than halved their holdings down to $1.4 billion worth of Nvidia shares. So a massive sell off for both hedge funds there. And it kind of explains why we saw such a massive decline in the markets, and explains why, for example, we see a faster sell-off for companies or just any assets really, why we see faster sell-offs than we do of course see kind of rallies, and that's ultimately because it's easier to almost offload 500,000 shares than it maybe is to slowly accumulate those 500,000 shares at the right price levels. So that's the kind of thing to keep in mind there. Pardon me. Now, many fund managers and analysts have recently warned investors that Nvidia is a part of a wider bubble and AI is ultimately overhyped. This message was made particularly well known by Paul Singer's Elliott Management, especially with the likes of Renaissance Technologies and Marshall Wace buying extra shares in Nvidia with. Pardon me, I've misspelt some of these things. With the likes of Renaissance Technologies and Marshall Wace buying extra shares in Nvidia, it's very clear now that there is growing divide between fund managers regarding the situation for AI stocks and the technology itself. So that's kind of what I spoke about earlier anyway. But that's all to talk about on the articles in general. Once again, very important topics to cover, and we'll kind of link back to it in the charts, which we're going to right now. So next to talk about is of course the charts, where like always we're beginning on the US 30 on the Dow Jones, where some interesting things are playing out following the recent rally that we've of course seen in markets. Now yesterday is really where we saw this massive rally to the upside play out, and because I'm recording this video far later than usual, somewhat of the price action for Friday has of course already played out somewhat. But if we go back to Thursday, we see what played out for Thursday. We can really see this massive rally to the upside. Obviously we started the week just below this key area of resistance, this key area of liquidity, lining up around the 3820 Fibonacci retracement level, and of course since then we've seen price break above that key liquidity zone over the course of Tuesday. Then Wednesday we saw this kind of period of accumulation, and then over the course of Thursday it seems like we've just seen this massive push to the upside, where price has gained massively and has pushed very near now to those recent highs that were made around the 31st of July, and then just above that, of course, the all-time highs made on the 18th of July. So the question will be, now that we're ending the week, whether we're now set to kind of experience somewhat of a retracement before we see a continued move higher. As often, these large rallies do require somewhat of a retracement to gain momentum again, to find that liquidity, to properly move higher. And so if I draw out this kind of Fibonacci retracement tool real quick, we map on those key levels. The levels which price could, of course, retrace down to is like 38.20, 50%. But then again, when we look at the charts like this, it's hard to see price maybe moving that far back down to the downside and then continuing a move higher. It just seems too kind of drastic to kind of do. Maybe if we take a kind of shorter Fibonacci retracement, if we map out a shorter Fibonacci retracement with the more recent price action, then possibly that 38.20 comes back into question, or even the 50%. So definitely look out for a Fibonacci retracement move today and starting next week. But of course, we'll come to this once again in the next weekly market briefing. Next about though is the S&P 500. Just quickly to kind of put into perspective what we were talking about just then with Nvidia, and what's going on with tech stocks, especially as that kind of rally that we've recently seen to the upside for the US 30, of course, is absolutely what's playing out currently for the S&P 500. But that slow sell-off and that retracement that we're possibly now going to see is also playing out on the S&P 500, as you have here with this kind of period of liquidity that's kind of but prices now come up into and is struggling to break above. But we'll keep you updated on this topic, of course, as we go into the new week. Next to talk about is the dollar, which ultimately has retraced and reacted to that kind of counter trend line that had formed over last week. And to start off this week, of course, we saw price break down and out of that area and then react to this lower level of liquidity, this recent low, to form a double bottom. That's when we then saw price swing back to the upside, and then and then of course we saw that swing to the upside, and now price has reacted to that counter trend line, is now selling off again. So the question will be whether, because price is now selling off, whether we'll see price break lower and break through that lower level of liquidity. Definitely keep your eyes on the dollar. Next to talk about is Euro USD, which is playing out in some very interesting ways, as of course price retraced over the course of Thursday with price selling off to the downside, where then price reacted to this area of liquidity and Fibonacci retracement level of 61.80, and now seemingly we're on the upswing. So it'll be a question of whether price breaks but above this key area of liquidity that price is moving into now, which should act as a key area of resistance. And should price break above that, we could definitely be looking at price making its way up to those Fibonacci extension levels around the minus 27.2. Next go out is pound yen though, which ultimately has kind of moved to the upside slightly over the course of Thursday, but now is seemingly kind of selling off once again. And this is just the kind of period of price action following such large moves to the downside. When we have such volatility within the markets, it takes a while for the markets to kind of get accustomed to what's going on again, and traders to kind of find their feet. So that's possibly what we're seeing play out at the moment. Definitely keep your eyes on pound yen though. It's so interesting to kind of see how things are moving at the moment, especially since price has now seemingly reacted to that 61.80. Next talk about though, if I just remove this though to make it more clear. Next talk about though is Bitcoin, which is back below the $60,000 a Bitcoin level. But as I mapped out in the last morning market briefing, there has kind of been a range that's seemingly formed over the past week or so, since last Friday, with price, with the bodies of the candles largely staying within this period of consolidation, accumulation, distribution, whatever you want to call it. Ultimately though, over the course of yesterday and now seemingly today, price has broke just below this key area of this key range, and the question is whether price will now return back into it, as that's seemingly what is playing out at the moment. This could be a false breakout, for example, where kind of liquidity is accumulated for a move higher maybe. So definitely keep your eyes on Bitcoin. Next up is gold, which is swinging massively to the upside after a massive move over the course of Thursday. So price did ultimately react to that 38.20 and key liquidity zone, which of course I did map out, and I said, you know, that was the kind of key level which price could be reacting to next. That kind of shaped up to be the most clean level for price to interact with and then move higher from. And now price is very much nearing those Fibonacci extension levels of minus 27.2, which is very close, which is just above the $2,500 announced mark. So definitely keep price on gold. Massive moves taking place at the moment. Last thing to talk about though is oil, which is ultimately broken to the downside and has now reacted to that 50% Fibonacci retracement level, it seems. But once again, think about the kind of key fundamental factors that are facing oil at the moment, especially Middle East, but then also the IEA forecasts, which have been messing with price. So lots to think about for oil. Very interesting price action though at the moment. Lastly, that's all to talk about on the charts though actually. Lastly to talk about, like always, is the economic calendar. We're receiving lots of economic data today, but basically all of it's come out by the time I'm making this video. So I'll go over that quickly. First, you receive the British retail sales figures, followed by the Swiss industrial production figures and the Eurozone's balance of trade figure. And then following that, across in the Atlantic, we're receiving the US building permits figure and then the US consumer sentiment figure. The only figure we haven't received just yet is the US consumer sentiment figure, but that should be out by the time you're watching this anyway. So make sure you catch up on all those figures and think about that as we go into the weekend. That's all to talk about on the economic calendar though. We've covered lots in the articles, lots in the charts, and lots of the economic calendar. Hope you have a great trading day, but that's all from us at Wildwood Capital. Have a great weekend as well. See you later. Bye.